everybody. So welcome to the Boule research meeting co-hosted by AladdinDAO and the BanklessDAO. AladdinDAO, just for people's background, AladdinDAO is an investment DAO focused on yield farming curation opportunities. So we have a group of top DeFi experts, and we meet regularly just to discuss the latest trends in DeFi and the top projects in the market. And we also turn some of the best strategies and ideas into protocols and products ourselves. And so far, we have built a concentrator and Clever, which focus on maximizing farming yields for Curve and Convex by providing compounding services and leverage services. And for today's meeting, we're going to have Jeff Tang, our Boule member, along with Aaron Wobler, Senior Credit Manager from Goldfinch, to present Goldfinch and to also talk about how they push crypto adoption to the real world. So I will pass it to Jeff and Aaron for the presentation, and we'll have Q&A after the presentation as well.
Awesome. Thank you, Charlotte. Can you share your
Jeff,
screen, please?
Do you want to take it over?
Yeah, I'll take over. Can you please share your screen? I'm on like a work computer, and so for some reason I actually cannot share my screen for some reason.
Hello, Jeff.
Hey, Charlotte. Can you hear me? Can you hear me?
Jeff, I think the screen is already shared.
Oh, really? Okay.
Yeah,
sorry.
I'm sharing the screen.
Okay, perfect. Thank you. So I'll just give a very brief background about myself. So I've been in high frequency trading
Jeff.
for the past. Hey guys, can you hear me? Can you hear me?
Yep.
Okay, cool. I'll give a really quick background. So I've been in high frequency trading for the past 14 years, and I've been in crypto high frequency trading for the past 5. And
Jeff.
hello. Yeah. You guys can hear me, right?
Yeah, I think it might be Sherilyn's issue. I can hear you.
Okay, so everyone can hear me other than
So Aaron, you can hear me, right?
I can hear you, Sherilyn, yeah.
Yep.
Great.
So
I think Charlotte can't hear me for some reason, but that's fine. So it might be tough for us to kind of like pass through the slides, but in any case, I've been in crypto for the past 5 years and in crypto VC for the past 5 years as well. I've been in DeFi for quite a while, and I've farmed on quite a few farms and traded on quite a few centralized exchanges. And I knew Goldfinch because one of my college classmates, Andrew Welsenbeck, he and I have kind of stayed in touch throughout the years, and he's been in this space, for his entire career professionally. And I think, DeFi is an amazing space. However, for real world assets, for real world DeFi, there only are really 5 platforms that are similar to this. So there's Goldfinch, TrueFi, Clearpool, Maple Finance, and Centrifuge. And for 3 of the 5, the middle 3, the borrowers are really, like crypto side. But here at Goldfinch, I think it's an amazing platform. And we've been kind of, chatting with each other for over a year now. And I think, I'm really proud that within DeFi, we're actually changing the world. We're really, making the needle move within the space. So, Charlotte, can you hear me, Charlotte? Hey, Charlotte, 听见吗?
Charlotte is just restarting her Discord because she couldn't hear you.
Okay.
So let's wait for a second.
Cool.
Jeff, helpful for me to give introduction before we start the presentation?
Yeah, let's do that.
Okay, great. Yeah, slightly different from Jeff. I'm basically been in traditional finance for most of my life. Moved over to Goldfinch about 6 months ago. I actually was born in Indonesia and grew up in Indonesia, so that's kind of where the focus on emerging markets comes from. and was actually based in Singapore for the last few years. And so I moved over here to New York, and previously worked in kind of doing what we do at Goldfinch, but in the traditional finance world, deploying private debt to emerging market businesses to use for on lending.
Awesome. Shawn, 你还在吗？
Hey, we'll see if we can get the slides over onto my machine, and I'll share for you.
Okay, sure. Do you need me to DM it to you, or you have it on Telegram, right?
Charlene sent it to me already, so I should be able to.
Okay,
get it.
perfect. I apologize, everyone. The last time that I gave a talk, it was unfortunately about Anchor Protocol, and this kind of happened as well. So I apologize. I don't think Goldfinch has any similarity to Terra ecosystem any whatsoever. So I think it'll be a much better chat.
All right.
Hopefully this is a contrasting presentation.
Oh,
Okay.
perfect. Great. Cool. Yeah, next slide, please. Great. And so I think I'll just start from the beginning and just assume that nobody's heard about Goldfinch before. So this is the general architecture of Goldfinch, and please, interject with any industry inside information if necessary. So Goldfinch is essentially a conduit between DeFi and real world finance. And so on this side, from the DeFi perspective, there's LPs, liquidity providers, and backers, which are on the junior side. And then on the other side, on the right side of this chart, there's borrowers who are, the real world neobanks, real world third party borrowers in the world who need to have loans to generate their business or to support their businesses. And so I'm going to talk really briefly about the general mechanism. And so there's two tranches. There's senior tranche and junior tranche, right? And so the junior tranche is the more risk savvy cohort within the lending community. So where they actually lend to a particular loan within the space where the net borrower is a new bank in either a developing country or within like Singapore, for example. And so they believe in a particular project, and the APY is relatively high within DeFi, so it can go up to 40-something%. And then the senior pool is kind of similar to a CDO or a CLO. I used to work in traditional finance. So I worked at the world's largest CEO conglomerate before crypto. And so, within this space, there is a concept of risk mitigation. So within the senior tranche, you have exposure to the entire space, but not necessarily any particular loan in itself to one of these third parties. And so this is a general architecture of how Goldfinch works. And I'm wondering, if maybe you can interject with anything else that's specific to this diagram.
Yeah, I think the one thing that might be useful for people is just how these positions are captured. So, as you said, because the senior pool is kind of a passive investment, everyone gets the same return. Effectively, the way the return gets captured in the senior pool is as a token. We call it FIDU. And when interest comes back into the protocol, it just accrues value in FIDU. So FIDU started at $1 and now it's at $1.07 or something. And so that's kind of like a tradable token that will always receive like PIK interest on from the underlying loans. Meanwhile, for the backer side of things, their specific position, the amount they contributed, which loan they contributed to, is captured as an NFT. and then cash flows come through to the same wallet that holds the NFT. And then that can also be traded on the secondary market, which is a functionality that we're working on at the moment. The other thing to note on the senior side of things, in terms of the senior token, if there's excess liquidity in the Goldfinch senior pool, you can go and redeem it for its exact value. And then we also have a secondary market trading platform on Curve Pool, which offers another liquidity option that includes people who aren't KYC. The other final thing to say is that everybody who deposits or withdraws from the protocol must have a UID that verifies that they've passed our KYC checks. So everyone who's depositing and withdrawing from the protocol has gone through KYC processes managed by third parties from Goldfinch and get an NFT to demonstrate that KYC process.
Great, thank you. Let's move on to the next slide. Are there any questions at this moment? All right, well, it sounds like no questions. Let's move to the next slide. Cool. So I'm actually going to breeze through these slides. So the essential piece of Goldfinch is that it's real world lending. So the lenders are on crypto side, but the borrowers are real world borrowers out there in the world. And, like in between, there is a middle layer. So like, obviously we're not literally lending to millions and millions of individual borrowers, but there is a layer of diligence where there are literally people and institutions out there that are diligencing for the platform. However, I will kind of go through various pieces of the puzzle. So backers are on the junior pool side, and so they kind of receive the majority of the reward. And so I'm curious, Aaron, if you have anything to kind of to supplement on this matter.
Nothing too much. Like you're saying, I think the backer rewards for individual deals are very strong. And as you're saying, they offer kind of a first loss position in the pool. And the logic being that, people who are willing to take a first loss, high conviction position on a very specific deal sends a message to the protocol that it's worthy of senior capital. And so that's kind of how the allocation of senior capital based on the underwriting of backers is supplied into deals that we think make a good portfolio for the platform.
Great. Let's move on to the next slide, actually, because I want to breeze through the theory. So auditors, this is what I mentioned before. So obviously, in this space, there's a lot of information asymmetry, and so auditors serve as kind of like a layer to prevent exploitation of the system, to be honest. And so I think, Aaron, it'd be great if you could kind of talk about like who the auditors are, how they're incentivized, and how this kind of fits into the entire system.
So first things first, the auditor function actually isn't rolled out yet. So at the moment, this is kind of a future state thing that we're working on live at the moment. But effectively, the purpose of the auditor is just to make sure there's no collusion between the borrowers as well as the lenders, and also making sure basically that companies pass KYC checks, they're real businesses. So in the meantime, like our credit team looks at the businesses to do those checks, and then we also require borrowers to pass the same KYC, KYB checks that all of our lenders do in order to kind of verify that they're a real business. In the future, I think the auditor function will be very robust and will be, rewarded in GFI. There's a decent amount in our treasury that's allocated for this function, and I think we're going to start seeing development of this auditor system in the next, sometime later this year.
Got it. Perfect. Yeah, let's move on to the next slide then, because this is from the white paper. Great. And so this is the general tokenomics. And so, obviously, when you lend to the protocol, and, I'm an advisor to very many yield farming, DeFi, quantitative hedge funds. and when they do a scan, they're usually ETH native. When they do a scan, on the top APYs was number one, and so like they asked me, hey Jeff, what's Goldfinch? Can you tell me what's going on? So I think it's really important to kind of explain Goldfinch, who they are, and how everything is kind of split up from a tokenomics perspective. And so Warbler Labs is separate from Early and Future Team, and this is a very early on page. And so Aaron, I'd be very curious if you can kind of like interject with how things are going at the moment. TG has been quite a while, and so how things are looking from the general tokenomics perspective.
Yeah. So I think things are playing out just as this chart would suggest. In terms of differentiating here between Warbler Labs and Early and Future Team, I mean, all of the team works for Warbler Labs and develops the protocol. So I would consider those kind of one and the same, although the Warbler Labs treasury has a bit more flexibility on what to do with their GFI. And then I would say what's exciting is that a lot of the GFI rewards that people are seeing on the platform right now that partially make our yields so appealing is coming from these backer and liquidity provider allocations. Basically on top of the USDC that is sourced directly from the deals that we originate, we also drop GFI on top of that with a function that basically incentivizes people to contribute earlier on in order to get those better GFI rewards.
Okay, great, perfect. And I just wanted to like kind of interject with my side of the story. So I personally believe that this is the best project within the space. I think compared to Centrifuge, which is the white labeled pool within Aave V3 real world assets, I think the background of the founders is quite outstanding. And like I remember in December of 2020, I looked at this deal as a VC on the C side. I unfortunately passed, but in terms of like the capital markets route, Andreessen Horowitz is the lead investor on I think every single round that they've done. They've raised quite a bit of capital, and this really is a big problem. And like this team is solving a really big problem out there. And I think that the future is really bright, and it really doesn't matter what happens to DeFi, what happens to crypto. This is the, the demand side is just quite outstanding, and you'll see it in one of the slides coming up. But maybe if you could, Aaron, talk about like the background of the founders. I don't want to talk too much about Andrew because he's my bro. Like if I talk about him in a positive light and he's not here, like it's kind of weird. But if you just talk about like kind of the team and the founders, and he was like the head of Branch International. Like if you just talk a little bit about everything, I don't want to embarrass myself. Kind of talking. I think that would be much appreciated. Thank you.
Yeah, sure. So Andrew's our COO, and then the two founders are Blake and Mike, who are both from Coinbase. They started the project in 2020, but we only really launched the platform at the beginning of 2021. And to echo what you're saying, I think there is just massive demand here. There's just so like basically since liquidity has kind of been sparse in the crypto ecosystem, we're continuing working with off-chain borrowers, and we have a line out the door to be able to access the protocol. And the thing that's like music to my ears is, I talk to these borrowers sometimes just to see how they're doing. And, I ask them, what do you think about the new crypto crash? And a lot of them respond with like, what crypto crash? I don't really follow that very closely. So this is like truly uncorrelated risk to what happens on chain. And especially because contagion is such a buzzword right now, and you're seeing all these different DeFi protocols or CeFi protocols as well, having exposure to one another. This is a problem that we don't have to deal with.
Let's move on to the next slide. So this is like pretty old data, but all of this is actually internal data, and I have permission to share this with you guys. And so this is kind of like to show you guys what the distribution is of the net borrowers, because like you want to know, as a net lender on this platform, who's actually borrowing from us. And while this is an internal document, you can go on the website, and that's on the last few slides, and actually see that, like what you see is what you get. And Aaron, if you could just, kind of comment on kind of like the breadth and the kind of the diversity.
There's intermediate entities. And so I think effectively the entity that we want the money to be getting to are fintechs in emerging markets. Although we're also open. And the actual amount of countries that we have exposure to now has increased to about 28. I think here there's a lot of Africa exposure, which is still true, but we also have a lot more Asia and some new LATAM exposure that would factor into this chart. And so just in terms of how the lending works, so these fintechs effectively look at opportunities in their emerging markets, develop lending products, but they need to be able to get international capital in order to scale their borrowing books. Basically, local liquidity markets aren't deep enough, and so they usually have to look for dollar funds in order to help scale their book. And so we're effectively wanting to lend to those fintechs with the intention that the money that we're giving them will be supplemented with their own equity money to originate a book of loans. And so this actually means that we're secured with our facility, not secured in the sense that, there's crypto assets backing the loans. Instead, it's that the assets that are originated with the loans that they get from us become secured back to us as creditors. So if there's an issue with the fintech, we still have that exposure to end clients that can be collected on. The other kind of caveat on how we do our lending is another kind of key partner we look at are credit funds that lend to fintech. So kind of like one step removed. The reason we focus on these guys is, first of all, especially in a decentralized protocol, underwriting is kind of paramount to make sure that there's people who are looking at these deals or people who are vetting these deals that we trust. And so having credit funds borrow and then lend to the fintechs means that you have a whole new layer of underwriting in between. And then the second reason is that these credit funds are really connected into the real world. They have a backlog of deals they've been looking to do for a long time, and so it's a good way for us to grow AUM quickly because these credit funds can have quite a bit of demand to absorb capital from the protocol. And sorry, just one other thing about kind of the underlying thesis of these loans. So basically, because a lot of the companies that we're lending to are fintechs, they're relatively early stage, they're startups, some of them are unprofitable. And so it's a business model that we believe actually has low credit risk. And there's a growing traditional finance industry around lending to fintechs, believing that, their technological capabilities add real value to their businesses, but local banks who can lend to corporates at the same rates aren't willing to kind of think about those models and assess them and underwrite them. And so we think this is a really unique opportunity because borrowers like these are able to offer kind of 10 to 12% USD returns and still be making good money on their end loans. And so we think it's a great opportunity where basically these markets are underserved and they're able to pass those costs along to their end borrowers while still being quite affordable.
Great. Let's move on to the next slide, please. So this is from the internal docs. I think, the Q1 and Q2 are projected. Maybe Aaron, if you could talk about how things have gone since then. I didn't share a very, very internal doc, but basically, I think there's $600 million of loans in demand from the neobanks, but obviously, it really depends. It's chicken and egg in terms of, supply and demand. And so we could just kind of comment on how things are going.
Yeah, exactly. Like you said, I think the tricky part about a model like this is you always have to balance both sides of the marketplace. And at one point we were capital constrained and had plenty of capital, and now it's flipped the other way. These are projections, and so just as an update of where we are now, we're at 100 million AUM. Effectively, basically we grew from $1 million AUM to $100 million AUM within the space of a year, backed mainly by retail money because we've only recently opened up our pools to accredited investors. So we're pretty confident that this growth is going to kind of continue very quickly once liquidity pressure has died down. But yeah, these figures are not actual numbers at the moment.
Well, let's just move on to the next slide, please. Then. So
Yeah,
these
there you
are
go.
real numbers.
Yeah, these are real
So
numbers.
this is the real growth, and I've been in DeFi for a very long time. I actually farmed on Compound Finance before they had the token, and so people will be surprised to know that to lend I or USDC in 2018, 2019, actually got paid like 11% without a compound token subsidizing the rate. And so, these the rates on Goldfinch are very similar to that. Obviously, there's some GFI for subsidization. However, I think looking through this graph, these two graphs, it is relatively healthy. You'll see that the TVL and the active loans are generally monotonically increasing. And so, Aaron, if you could just kind of talk about this process and kind of the experience over the past year.
Yeah, exactly. And these are really good charts to have side by side, because the way to think about it is actually like active loans is a subset of TVL, and our TVL will never be able to drop below the amount of active loans, because effectively money's already being deployed if it's active in a loan. So as you can see kind of in that May time period, when the Luna crash happened, a lot of people wanted USDC, so the excess USDC was pulled from the protocol. But the amount of TVL, the amount of loans outstanding, stayed exactly in line with the amount of active loans we have, which I think is a necessary feature of the product, right? If we're able, in order to actually get good returns that are based on economic activity, people need to have money for a while in order to be able to recycle it, put it to work. And so from our perspective, this is kind of a key feature of how the protocol works. I would say it's slightly different for most people who work in DeFi. I think a lot of people want to be able to demand high yield as well as instant liquidity. But I think this is a reality that's kind of going to become less and less possible over time once we realize that in order to get high yields, you actually have to be able to deploy these loans in large quantities for a decent amount of time to borrowers who can then, turn money into more money. It's a bet on growth rather than a bet on like arbitrage opportunities while asset prices are going up.
I'm gonna fly through the next few slides. So let's go to the next slide, please. So like obviously really important when we're talking about like real world lending is also like default risk and repayments and like how everything kind of goes together. So you see here that the top chart is repayments. It's relatively healthy. It's this 30-day moving average. So that's why everything kind of is like not necessarily like a smooth function. And then the bottom part is on the gain side. So the gains this page is flickering for some reason, but the gains is relative. So if you look at the white paper, the protocol actually receives, I believe, 10% of all the net that's coming in, and so this is almost a monotonically increasing function, and so that just shows you that like I believe so far there's been no defaults. Is that correct, Aaron?
Yeah, that's correct. And so a couple of things to know on this chart. So firstly, on the one above, we actually had 2 borrowers repay their principal in the last few days when it came due, which is why you see that big uptick, which provided more liquidity to the senior pool. And then on the bottom chart, as you mentioned, this is basically a chart of interest since there's been 0 write-downs to date. The other thing to note is that the protocol also gets revenue from fees when people redeem FIDU, the senior pool token, which is a 0.5% fee. And so if you looked at the bottom chart on a revenue basis rather than just interest, there was also a big tick up during the time the Luna crash happened because there was a lot of fees that were received for redeeming FIDU and getting it back into USDC. So there's a couple different mechanisms that the protocol receives revenue. And just to note, this revenue all goes into the protocol reserve. There's no kind of external payments that have to happen. Our team isn't incentivized by payments on the protocol. And so this money just goes into reserve. And I think what's interesting is, we recently announced our kind of next version of tokenomics, which basically gives a portion of those reserves for people that contribute both GFI as well as capital to the pool in order to incentivize activity that helps us grow TVL.
thanks. And I do want to fly through these slides in the interest of time. So let's move to the next slide, please. So this is just an example to let you know like what the pools look like, and so you'll get a like kind of a feeling of how large the junior pools are. These are real loans, by the way. So this is like literally Alma basket number 4 is literally $10 million. That is the real interest rate if you lend to this as a junior pool. By the way, this is all junior pool level. Aspire is, I believe, out of Singapore. Like Karis, DivBank, PayJoy, QuickCheck, Tagunde. I believe Tagunde is out of Kenya. So these are like, you know, real world borrowers out there. And so I wanted everyone to kind of see what's out there, the general rates out there, the general size of all the deals. Let's go to the next page, please. And then this is just to give everyone like an idea of what the UI looks like. And so if you go to Goldfinch, Goldfinch is a little bit different from normal DeFi. So there is a KYC component, and the senior pool is the last layer of losses relative to the junior pools. The senior pool is liquid, so you'll see that APY here is 16.8%, of which 7.8% actually comes from the protocol, and then 9.01% comes from the token through the through subsidy, essentially, right? And so, you know, if the price of GFI doubles, then the APY on that side will be much higher. If the price of GPI halves, then the API will be lower as well. And then obviously, I don't know, you know, everyone's experience in DeFi, but basically, like if TVL doubles, then you know the APY will go down, and then if TVL decreases, then the APY will go up. Let's go to the next slide, please. So this is just an example of one junior tranche. This one actually got called. But regardless, I just wanted everyone to take a look. So the APY is 10% on the real world side. The side of the pool is 5.1 million. If you go to the next slide, this is the history of all the payments. And so I'm just going to go through these line items. If you look at the bottom, it's a $4.875 million pool, junior pool, 3 years. If you actually deposit into the junior pool, you're actually stuck for quite a long time. And then you'll see that it immediately got drawn within 1 day. And then, you know, these repayments are literally interest payments, right? And so this is a real loan. And so there are interest payments that happen on approximately a monthly basis. And then you'll see on March 4th of 2022, the borrower decided to essentially repay this loan. I'm actually curious what happened here, Aaron? For
Yeah,
this particular...
it's a good question. So, I mean, the first thing to note is that, like, unlike most traditional finance debt deals, we have no prepayment penalty. So if people want to prepay their loans early, that's totally fine. In this case, AlmaVest, so this is a deal with Oya, which is a fintech, and then AlmaVest is one of our credit fund partners. And so the reason this deal got taken out here is because we raised another fund with AlmaVest at a better rate that they then took the Oya position over. So there was just simply a transfer of positions rather than a repayment for any kind of external reasons.
Cool. So that's the end of this presentation. I think it'd be a good time now to see if there's any questions. Jarlin?
Thanks for the presentation. I'm interested in especially the DeFi token. Is the supply kind of regulated, or is it unlimited, or?
Yeah, I think we've committed to no inflation for the first 3 years. I hope I'm not speaking out of turn, but I think that's correct. And so I think the overall supply now is about 110 million tokens.
And when you get to the yield, part of it is paid out in it. Where does it come from? Is this the company Goldfin itself where the DeFi comes from? How does it
Yeah.
work?
Yeah, exactly. So GFI was launched as our governance token at the beginning of this year. And there's a bunch of GFI that's used for those different purposes we had in the pie chart earlier. And part of those is paying out incentives to both the senior pool as well as the backer pool. And so all that money just sits in the treasury. And the way that it accrues is basically every time a new backer interest payment comes in, that triggers release of a certain amount of GFI. And then we have a model that basically, for the first X amount of interest payments, there's GFI incentives that decrease over time, again, to reward people who get in earlier than later.
I see, thanks. And how is demand then for BFI created? The ones that have this BFI, do I just hold it for more API or to contribute in the governance, or how does it work?
Yeah, so GFI allows you to participate in governance in its current form, and then in the future, GFI will be part of what we call membership vaults. And so, as part of our tokenomics, we are going to have people be able to stake a combination of GFI and investment positions. So whether that's senior pool token or junior pool NFTs, and through that combination, we'll be able to get increased governance power as well as access to fees from the protocol. And so effectively, we're trying to incentivize good behavior on the protocol and have people that are both interested in the long-term value of GFI as a token, as well as the ongoing deals and supplying capital to increase TVL. And so the GFI token and Goldfinch in general, the reserve will continue building up based on the fees that we receive from interest as well as from redemptions, and that all sits in the treasury. And so in the future, there can also be governance action about what to do with those reserves, and they can be paid out to GFI holders as a potential use case in the future. As I mentioned previously, the current setup or the current tokenomics proposal that just passed basically allocates 50% of those fees to go towards people who have supplied both GFI and capital and staked it into the Goldfinch protocol.
Thanks.
Yeah,
Any other questions?
Yeah, I have a question. So there has been quite a bit interest around this Frax Goldfinch AMO in the market. So can you guys please just explain the details, how it's going to work exactly?
Sure, this is
Question.
actually not my area of expertise. I know that we've been talking to Frax, but it hasn't been a conversation I'm involved with. So I'm not sure of the latest update there, but I know we have a proposal out there for Frax to contribute to the senior pool, providing capital still via the same channel of using USDC. But there's also potential collaboration opportunities with Frax in other ways into the future. But unfortunately, I don't have the latest update on that conversation.
I can plug in for maybe 30 seconds. So I'm like, unfortunately, an algorithmic stablecoin guy. And so Frax is obviously an algorithmic stablecoin. I didn't invest in Frax, but my buddies at Dragonfly did. And so basically, Frax is a partially collateralized stablecoin. When the price is lower than one, then there's some combination of FXS that gets burned to mint, and that supports the peg. It's approximately 72% collateralized if you get rid of all the FXS and get rid of all the CVX. There's plenty of literature out there that kind of talks about the balance sheet of Frax. Frax is an amazing project. Frax and Fei are kind of the only two algorithmic stablecoins at the moment after Luna imploded that are quite viable, and I think will still be around, 2 years from now and still be part of the general zeitgeist of the industry. But to kind of bring this conversation back to Goldfinch, there is a mechanism within Frax. So to mint FRAX, which is a stablecoin, you technically have to provide USDC and FXS, which for other stablecoins out there that are of the algorithmic mechanisms such as USDD, USDN, USN, Celo, so I guess CUSD. The only way to do it is through the governance token. Frax is so brilliant in that they actually came up with a workaround where you can actually bring in some other stablecoin and you can bypass the method. And there's two kinds. One of them is through Curve. So you can have a Curve AMO, and then the other way is through this non-Curve AMO mechanism. And so Goldfinch is through the non-Curve mechanism. So this stuff doesn't actually go through Curve, even though there's a pool within Curve. And so there's this token called like FIDO, right? Is that correct, Aaron?
Yeah, that's correct.
Okay, so like FIDO is like kind of like an interest-bearing token, and if you've been in the stablecoin space for long enough, you kind of understand that it is what it is, and like who knows whether or not this thing is sustainable long term. But regardless, Frax has basically minted $100 million of this token, and it's going to be deposited into Curve. And so this is a great collaboration between Frax, which in my opinion is the best algorithmic stablecoin, and Goldfinch, which in my opinion is the best real-world DeFi protocol. And so this is literally a hack. This is literally a hack. There's no minting, so no FXS and USDC has been deployed. If you look through the white paper of Frax, technically for the non-Curve section of AMO, there is a USDC component, and so there will be USDC in the Curve pool, so it doesn't just like mint itself out of thin air. However, the mechanism is quite trust based, and so there isn't literally a 100% backing of this pool. So it is, it's risky, but it's basically betting on the fact that these two protocols will generate the yield that is necessary to support both ecosystems. And I don't know, Aaron, if you mentioned that you don't really understand what's going on in this space, or this is not your area of expertise. I'm not really an expert on this space either, but I have read about what's going on here, and so I don't know if you have anything else to add to this piece.
Yeah, not too much to add. Just to note that the idea is for Frax to be able to contribute to our senior pool, and they'd be doing so kind of in the same way using USDC or using the Curve pool where we have the FIDO token available. And so it's kind of a longer term plan for us to be able to get liquidity, but also give opportunities to companies like Frax who are looking for a real world asset yield to help back up their stable coins. And I think there's a lot of partnerships out there with other like-minded stablecoin issuers that we're having as well.
Understood. So basically, that's the AMO says is $100 million. So basically, as long as it's below the cap, right? So Frax just can top up USDC into a Goldfinch lending pool. Is that correct?
I believe. Sure if we've finalized the exact deployment schedule or the amount yet. I know that we've had discussions, but I think there's still discussions going on between our senior management on how exactly to implement the solution.
Yep.
Cool. Are there any other questions? Let's field one last question because we are 15 minutes past the schedule.
If nobody else wants, I have another question.
Sure.
So you mentioned that nobody has defaulted on all of it. Is that correct?
Correct.
Or is it that the underwriting process worked and you were eliminated from the risk?
Yeah, so I mean, I think there are two slightly different things. So we have had no defaults to date, which I think proves that the underwriting works, that the lenders on the platform, as well as us who work with the borrowers, have checked all the documents, make sure everything is in line. And so yeah, we've been able to achieve a 0% loss rate to date.
Is that something that you think will continue, or is there what would have to happen that there is actually a default? Would that be that your partner actually, the credit partner, defaults?
Yeah, exactly. So if the credit partner who we've lent money to defaults, then there could be a default on chain. Just for context, we have guarantees from all the entities that we lend to. So we're not simply relying on the end loan collateral to recoup all our investments. We also have recourse to the balance sheet of borrowers. But if one of these borrowers did default, then we would have to enter bankruptcy proceedings, enforce against the security that we have. And this is all capability that we're building out now. And then in terms of actually managing these processes, all the people who contribute money to a deal get added to a part of a live data room whereby they can issue notices of default, or borrowers can issue notices or FYIs about their portfolio performance, do regular portfolio reporting. And so the idea is that we should, while the bulk of the underwriting happens at the beginning, we also need to be keeping a pulse on these companies, and also make sure that they're maintaining, within the levels of covenants that are set out in the real world docs. And those are all levers that we have to kind of continue monitoring the riskiness of the portfolio and engaging any borrowers that we think could potentially have any issues. Thank God for us, none of that has happened to date. I think in the future, this is a debt portfolio. There will be defaults at some point. We hope not for a long time, but we're also working on those communication channels, as well as just community grants and opportunities for people to be able to intervene in cases where default scenarios do play out, and you need experts to kind of help manage those processes. But we do have a lot of protections in our real world docs. And just for reference, basically anytime someone contributes capital and digitally signs on our platform, all of that information goes into a real world loan document that has the same recourse and the same rights as you would if you were a real world creditor to a business in fiat.
Thanks.
Cool. Cool.
That's
Awesome.
as long as there's nice weather, everything is great, right? But we have to be prepared for the rain.
Yeah, exactly. I think in my opinion, in this kind of like recent blow up of DeFi, there's just been basically taking on crazy amounts of market and liquidity risk and ignoring credit risk, because a lot of DeFi protocols don't really want to have credit risk. It's automatic liquidating loans. But I think the next generation of DeFi really needs to realize that taking credit risk is how you get return. And so we have a lot less market and liquidity risk because we're not actually correlated to how crypto markets move. But on the credit risk side, this is kind of a necessary evil in order to get good returns. And so I think this is something that our community will learn over time, and we're hoping to build out a community even outside of Warbler Labs that can support this underwriting as well as loan management process.
Cool, thanks.
Awesome.
Very interesting.
Hey, thanks, Aaron, for your time. I really appreciate it, and I learned a lot today, actually. And I generally think that in the real world asset DeFi side, I've been in DeFi for a very long period of time, and the only project in DeFi that I get really excited about is Goldfinch. And unfortunately, the token is not doing as well as I kind of wish. And I have no exposure to this token, by the way. Like, I think Andrew is one of my best friends, and so I'm just always here supporting him. But in general, I'm just really happy to kind of share this project. And I generally within this space feel like the most important thing about crypto is changing the world. And like, I was a seed investor in the Giving Block. I think the Giving Block is one of the best companies out there because they literally connect crypto charity to real world charities. And then the Giving Block is a great company. They exited recently. I think technically Goldfinch is just as awesome, if not better. We're literally helping people fulfill their dreams and to really support and bridge the gap between what's going on out there. And I give a lot of talks about crypto, and these are things that like make me feel very excited about the space. And the space is crypto space is really, really large, and there's a lot of stuff going on. There's companies like coins.ph in Philippines where they kind of minimize the cost of remittances within the country. But there's a very small handful of projects out there that I feel like, I'm very proud of being in the crypto space for, and I just support regardless of what happens in this industry. And I think that Goldfinch is really one out there, and I'm proud of you guys, and I think that you guys should really build. And bear market, bull market, whatever happens, this is what crypto is out there for. And so yeah, like if you guys need anything, I'm here to help you guys out.
Thanks. Really appreciate the support. And yeah, I mean, we received our Series A funding in January. We have tons of runway. We're going to be building through the bear market and really excited. We think this is kind of like the next generation of DeFi that's out there. And then a final point on kind of the impact side of things. We have an impact tracker that we just pulled together with our borrowers, and we're almost at reaching 100 million people with loans. And so these are primarily underbanked people in emerging markets who need this finance and need to be financially included. And so getting to that million person mark is really exciting for us. And hopefully it's going to be, multiples upon multiples of that going into the future.
Exactly. These things are really touching. When I invested in TGB, the Giving Block, I didn't care about making money. I just really wanted to connect charity to crypto. And I feel like, unfortunately, I have no exposure to Goldfinch, but I feel like, just knowing this project from a personal perspective, it doesn't matter if you guys make money. It doesn't matter if you guys like do this or do that. Touching people is the most important thing about crypto. It's about like, leaving your footprint and your legacy within the space. It's about, later down the road, being able to tell people that, hey, I was in crypto and I did this and it touched 100 million people, 200 million people, 500 million people. Like, this is why we're in this space, right? We're like here, DeFi is like decentralized and it's finance. We're trying to actually make the unbanked. We're actually trying to make a difference in the world. And so I think, hopefully everyone can kind of think about that. And, it's, crypto is what it is. But within DeFi, this is a really big industry, and this is a very big, I think, like I don't know how to say it, Aaron, like how like anyway, but yeah, I just wanted to leave that as kind of like the last words in terms of, I think everyone should take a look at Goldfinch. I think it's a great project. The token itself, I think from a utility perspective, it's not that great. I think there's a lot to be done on the tokenomic side. However, I think as a project, regardless of the token, the project itself is very, very solid. And so I'm like a huge fan of the project itself. And so I don't know if you have any other like final words to talk about in terms of Goldfinch.
Thanks, Jeff. Really appreciate the support, and I'd also love your views on tokenomics. It's also a relatively new project for us, but yeah, just to echo what you're saying, I mean, I think the most exciting thing for me, and the reason I moved from traditional finance into DeFi, is that basically there's a pretty bloated, fee extractive capital supply chain in traditional finance right now. And whether that's because overregulation or things just got too complicated over time or there's too much profit motive, there's just so many places where these end borrowers, who are the ones putting the money to work, get fees passed on to them and don't benefit from information symmetry. And so the cool thing about this is when we are able to talk to people and talk about the different actors in the supply chain that we disintermediate and that you don't need to pay any fees to come onto the protocol, borrowers' eyes just like go wide. The product sells itself and makes my job a lot easier. But I think a decentralized approach to credit funding, especially when it comes to funding the underserved, is really a necessary innovation and disruption to traditional finance markets, which, like I said, can be too fee extractive and end up benefiting the financial intermediaries less than the people who are actually putting the money to work and the people who are using the money.
Awesome, great. Yeah, so let's call it a wrap, Charlene.
Yeah, great, guys. So thanks so much, Jeff and Aaron, for the presentation and all the insights you guys shared. And we really look forward to bringing you guys back again sometime in the future.
Yeah, we'd love to.
Yeah.
Hey, Charlene, I gave my last talk about Anchor in Chinese, so I'm just so happy that I finally get to speak.
Also, it sounds like a few of you are based in Singapore. I used to live there and I come through pretty often. So next time I'm in Asia, we should have a meetup in person.
Yeah,
Definitely. All right. Take care, guys.
Jeff, you have done so well today, in particular after all the alcohol stuff.
Great.
That's amazing.
Thanks so much, everyone.
Yeah, thank you so much. And if there's no further questions, so let's close for today's meeting.
Great.
Thank you.
Thanks, everyone.
Thanks a lot.
Okay,
Bye.
thank you guys.